I would like to show you in this video how to actually journalize these adjusting entries. We used what was called a worksheet to prepare the adjusting entries, but that's just a working tool. To make it official, you actually have to journalize. So we're going to take these each individually. The first one is a prepaid expense, or what we call a deferred expense, because we've deferred it from being an expense until later, until once we've used it up. So one of the typical ones is called insurance. So for example, on December 1st, A Plus Plumbing purchased a 6-month insurance policy for $600. As of December 31st, 1 month of that has expired. So complete the journal entry. So first we'll start with on December 1st, when you actually purchased it, what did you do? So put in the date. Yeah, we can use 2017. December 1st, we bought it, so it became prepaid insurance, and that's an asset. And then we credited our cash in bank, and that was for $600. So right now we've got $600 sitting in our asset account. Okay, we used an asset to pay for an asset, but we haven't actually used the insurance yet. So now we have to actually show that 100 of this at the end of December 31st, at the end of the month, has actually expired. We no longer have 600 sitting in prepaid insurance because we used up a month. We only have 500 sitting there. So we have to expense 100. So let's get rid of the 100 from prepaid and expense it into insurance expense. So there's my debit and there's my credit. And now my balance in prepaid is 500. So how do you do that? Let me just merge. This right here, I should go back and tell you that the source document was probably a check. Oh, I do have that. Here's your increase indent button, and then you can write whatever check it was. For adjusting entries, there really isn't a source document, so we just center adjusting entries, and then you would do all of your adjusting entries right here. This is December 31st. And we already did the adjusting entry using our T accounts up here. So now we just debit insurance expense and credit prepaid insurance. So your adjusting entry should look like this. You debited insurance expense and credited prepaid. Try not to use the spacebar to indent. Google does not really have the capability, especially if you're in a Google Sheet, but you do have an increase indent button in the Google Doc as well as in Excel. The next one is unearned revenue, or when we deferred the revenue. So that's when we receive a payment for a good or service, but we haven't actually earned that revenue. So one of your customer gives you money, but you haven't earned it yet. So maybe you own a building and they paid you 3 months worth of rent in advance. So now we have to expense it and show that it's been used, or we've actually earned the revenue. So in this example, for example, on November 2nd, Huber Rental Properties received 3 months rent totaling $2,400 in advance for one of its commercial properties. As of December 31st, because we are doing our adjusting entries at the end of the year, 2 months worth has actually been earned. So let's show what the journal entry would look like for for November 2nd, to get an idea of what actually is happening here. So first we're going to put in the year, in November 2nd. And for this one, we received it, so we received the money and we haven't earned it. So we would have debited cash and bank and credited rent revenue, but we haven't earned the revenue yet, so we actually owe our customer rent. So this is going to be unearned rent, which is a liability account. 2,400. So now we have to actually show that we've actually gave them the building, they used the building for 2 months, so we've actually earned 2 months worth of that 3 months rent. So 1 month should still be a liability. Okay, so let's go ahead and do that. I don't know why you don't have a table in there, so I'm going to copy and paste. So if I get out my calculator, so take 2,400 divided by 3, and you will see that it's 800 per month. Okay, 800 per month. So on December 31st, again, go ahead and write adjusting entries. And we've actually earned, so we're going to take it out of our unearned rent. 1,600 has been earned, and credit your rent revenue. So now we still have 800 of unearned rent. The next one I want to show you is accrued expenses. So accrued is when an expense has happened, but you haven't paid for it. A great example is wages. So if your employees work December 31st, they don't get paid on December 31st, so you owe them money. Okay, so on that date, okay, Huber Rental Properties owes $500 in wages to its employees. These wages will be paid on Friday, the usual payday. Okay, so there wasn't an original entry. Up here, this was a deferred expense, okay, or deferred revenue. We already had an original entry, and then we have to figure out what the new balance should be. Here we're just adding it. Okay, there was no original entry, so all we have to do for the accrued expenses, all we have to do is get it on the books. So we actually had an expense, wages expense, we just haven't paid it yet. So we would have debited wages expense and credited cash and bank because we gave our employees their paychecks. However, we haven't done that yet, but we do owe it, so it's a wages payable. Okay. And then the other one is accrued revenue. So maybe you're working for a customer and at the end of the month, they haven't, you haven't billed them out yet. Okay. Another example would be interest. So if any of your businesses owe you, any of your customers owe you interest, that would be something that has accrued. So an example would be Huber Properties granted a customer additional time to pay an invoice. However, the customer must pay interest at a rate of 10% annually. At the end of the accounting period, the interest that accumulated totals $80. So how are you going to do that? No original entry, we just have to get it on the book. Accrued, we need to add it, okay? Add it to the books. So we're going to debit accounts receivable because our customer owes us that interest, and that interest would be revenue to us, so we would credit interest revenue. for $80. All right, we have one more. We're going to adjust for depreciation. Assume that your car needs 4 new tires. One set of tires you are considering costs $200. The manufacturer estimates that these tires will last 20,000 miles. Since you drive about 10,000 miles per year, that equates to 2 years. Another set of tires cost $300. These tires should last 40,000 miles or 4 years. Assuming that you plan to keep your car at least 4 years, which set of tires is the best deal and why? So if we take a look, the first one, if you're considering it's $200 and they're going to last 20,000 miles, these are only going to last 2 years. 2 years, so it's going to cost you $100 a year for depreciation. This one, they're going to last 40,000 miles or 4 years. Okay, so it's going to cost you $200 for the 2 years, and then it would cost you another $200 to get it for another 2 years. So that'd be like you'd spend $400. These cost $300, and they're going to last 4 years. So you depreciate the $300 over 4 years. So let me see what that is. 300 divided by 4 years is $75 a year in depreciation. Okay? So let's actually see how we can depreciate this. The accrual basis of accounting requires business owners to allocate the cost of fixed assets to the years they are used, and this is called depreciation. So a florist purchases a delivery van for $12,000. The van will last 3 years. What is the florist cost per year for this van? The cost of the van per year is going to be $12,000 divided by 3 years to give us $4,000 per year. That's all I think we're going to talk about for this. Okay? So we're going to have to depreciate that van, but we're going to use that account called accumulated depreciation. Okay? When you bought that van for $12,000 on January 1st, you debit to delivery equipment, which is an asset, for $12,000 and credited your cash in bank. So now we can't show that the delivery equipment is worth $12,000. We have to depreciate it to show that every year it's kind of worth less, but we don't want to touch the delivery equipment account. So we're going to use what's called a contra asset account, which is your accumulated depreciation account. And we're going to depreciate that 1 year that has actually been used up. Since delivery equipment is an asset, it does increase on the debit side. Accumulated depreciation goes against this. It's a contra asset. So contra is opposite signs. So accumulated depreciation will go against the delivery to kind of show you what the book value is. This minus whatever in your accumulated. So for the first year, like we said, we take the $12,000. There's something called residual value, so you have to figure out how much is it worth at the end of the 3 years. How much could you get out? What's the salvage value? We're just going to say it's nothing. So $12,000 minus your salvage divided by how many years you plan to use it. So you need to expense $4,000 of this every year. And that's where we will credit our accumulated and then actually debit our depreciation expense for $4,000 because we've used that equipment to actually generate revenue, so we do have to expense it.